So in this episode, we're going to answer the question, how to create a solid financial plan in your 60s. Welcome to the Personal Financial CEO podcast, where we discuss personal finance and financial-based strategies to help you live your best life. Welcome. My name is Boorstein. I'm a financial planner and founder of Rockcrest Financial, which is a comprehensive financial planning firm in Somers Point, New Jersey. One of the questions that I get pretty frequently throughout the year is, how do I create a solid financial plan? And most often, this question is asked by a couple that are either in their late 50s or somewhere in their 60s. So that's the question that we're going to answer today. So two quick disclaimers. First, this is not personal financial planning advice. This is educational information because I don't know your particular situation. And second, if you don't have an advisor, then you are your advisor. So I believe that there's 5 critical areas to every good, solid financial plan, especially in your 60s. So the first critical or central area of every financial plan should be your values and your goals. These are both different, but the first part of the plan. Your values are really the why behind why money is important to you. And at a base level, for many people, that may be that they just want to make sure they don't run out of money so they can afford the base necessities in life. But as you ask that why question, so why is it important that you have your base level of money taken care of? People have different answers. So your answer may be that you grew up and you didn't have a lot of money and your family wasn't so wealthy, and you want to make sure that that never happens again throughout the rest of your lifetime, or that it never happens to your kids. It could be some other reason. And as we go up the why ladder of, well, why is that important to you? It may be that you have worked hard your whole life and you want to enjoy your retirement, or that you want to provide for your grandkids, or it could be that you feel that the money that you have is a blessing. So as we go up the hierarchy of the why behind why money is important to you, we try to get to really your deeper and deeper values that motivate you. So once we've identified your values, the next thing to look at is your goals. And this is where I think a lot of advisors and people that do their own plans get it kind of not exactly right. Your goals should be very specific. So I want to be safe in retirement. It's kind of a goal, but it's not a very specific goal. All goals should have a name, they should have a date, and they should have an amount. Because in a financial plan, every goal should have a timeline as well as an amount that needs to be planned for. So, for example, rather than say, well, I want to reach retirement safely, it would be my goal is financial independence by August 6th of 2030, and I need to have either, in today's dollars, $120,000 in annual income, or maybe the goal is I want to have $3 million in assets. So that would be a very specific goal. Another specific goal would be, I'd like to have a second home in retirement, and in today's dollars, that's $600,000, and I want to have that by 2035, and that would be another goal. So goals are very specific and are something that require both planning and money. So when you do your financial plan, that first critical area should be your values, and then each of your goals with a name to the goal, a date to the goal, and a amount that needs to either be saved or a level of income. So what are some examples of goals? Well, one would, of course, be your retirement income. Another might be a second home, as we discussed. Could be travel goals. Could be, small trips throughout the year, or it could be one large trip that you take each year or every several years. Could be a major purchase, like a boat or a car. Could be college for yourself, for your children, or for your grandchildren. Could be saving for things like weddings or starting up a business in retirement. Because for some people, retirement isn't really retiring. It's just the new chapter in their life and the things that they want to do. It could be legacy planning. So you could be saying, hey, no matter how much I spend throughout my retirement, I want to make sure that my children have X amount of dollars after my will matures. So it could be any number of those goals or other ones, but each of those goals has a specific name, specific date, and a specific amount that you need either saved or to spend. The second critical or essential part of a retirement plan for someone in their 60s is their tax strategy. And so it involves both short-term tax strategy to pay less taxes now, as well as a longer-term tax strategy to pay less taxes later. And the reason this is important is because for many retirees, a majority of their assets are often in some type of retirement plan. So whether it's in their 401k, their 403b, or an IRA, at some point in time, the required minimum distributions that they're going to have to take in their 70s and later may exceed the amount that they actually need in order to live. And so they're going to be paying taxes on distributions that they're not actually using. And so proper planning in your 60s can often help reduce those taxes during that period of time. So I often suggest, especially for clients who are higher net worth, to make sure that they work with an accountant. If you have an advisor, your advisor should be working very closely with your accountant. The role of your advisor is critical here because they should be helping to make sure that the tax strategy fits in with the overall financial plan. Often your accountant may know the tax portion, but may not know the whole game plan of the comprehensive financial plan. And so your advisor is kind of the critical centerpiece in making sure that all the other financial professionals that you use are coordinated and all working on your behalf towards the goal of the overarching financial plan that you have. So the next critical area that needs to be in every financial plan for someone in their 60s and beyond is estate planning. And this could be as simple as making sure that the beneficiaries on every account that you have are named so as when possible to avoid probate. It should include at least a basic will, and it should include your powers of attorney, namely your medical power of attorney and also your durable or financial power of attorney. There's many services online that can help you create these. My strong suggestion is that you work with an estate planner or your advisor work with an estate planner along with you, because the advice of an attorney in this area is extremely important, especially if your situation is more complicated. It avoids battles between family members. It helps avoid situations where what you've done wasn't the intended consequence of what you initially set up. So estate planning is very important, especially when creating the wills and powers of attorney. In some cases, clients may need trusts My personal feeling is you don't want to take a thumbtack and hit it with a sledgehammer. So you don't want to make your estate plan more complex than it needs to be. But depending on the state that you live in, or depending on how your assets are titled or the types of assets that you have, or your situation with regard to minors or children with permanent disabilities, trusts may play an important part in your overall estate plan. And so it's important to get it done right. Now, I also want to mention that doing your estate plan doesn't necessarily mean that you may not need to change it later. My feeling is your estate plan needs to be as complex as your situation is currently and for the anticipated future. And then as your situation changes in the future, you may need an update to your estate plan. So it's important to make sure that you review it regularly and that it meets what your current as well as your future needs are. And when those future needs change, that you wind up modifying the estate plan. So an estate plan is not something that's set in stone and lasts forever. The other area would be legal protection if you decide to start a business or if you have a business in retirement. So just because you've retired and maybe decided to collect Social Security doesn't mean that you may not have a business or work somehow in retirement. So making sure that you have the protection that if you're ever sued in retirement or ever are subject to some type of legal situation, that you don't lose your hard-earned assets is extremely important, especially throughout retirement, because your ability to recoup those assets are going to be very limited at that point in time. And again, the role of your advisor in here is to kind of coordinate your estate planner, your estate planning attorney, along with your accountant, because taxes and estate planning are very closely linked, and making sure that all of those things work together and fit into the overarching financial plan. So critical area or element number 4 is investment management. So whether you do it yourself or whether you hire an investment manager or a advisor who is an investment advisor and manages your assets for you, or whether it's a combination of you managing some of your assets and your advisor managing some of your assets, that is a critical strategy to your overall retirement. So it should encompass not only your values and your goals, but your tax strategy and your estate planning strategy. And also critical area number 5 that we're going to talk about in a little while, which is your risk management strategy. So your investment strategy should embody all of these aspects together and make sure that they're providing, or it's providing, the level of income that you need, the ability to reach all your goals, both current and future, in the most tax efficient manner, adhering to the estate planning goals that you have, reducing risk to the level that you're comfortable with, and reaching your overarching financial plan. And for everyone, this is going to be different, right? So your investment management strategy is going to vary depending on your particular situation. And for some people, that is stocks, exchange traded funds, mutual funds, individual bonds, commodities, real estate type of investments, individual real estate in some cases, alternative types of investments, and so on and so forth. So whether you're doing it yourself or you've hired an investment manager to help, it's important to make sure that your investments fit into your overarching financial plan and match the tax strategy that you've created with your accountant, your estate planning strategy that you've created with your attorney, your overall goals and values in your overarching financial plan, as well as critical area number 5 that we're going to discuss next, which is your overall risk management strategy. So that brings us to the critical or essential area number 5, which is strategies to reduce risk. Now, one of these strategies is the overall view of insurance. And it doesn't necessarily mean purchasing insurance, but what it does is it means looking at the strategies and the risk that you need to cover. And so I'll give you a good example of that is long-term care. So for some people, that may mean purchasing long-term care insurance, whether it's a traditional long-term care policy or whether it's an asset-based long-term care policy. For some people, it may mean just earmarking enough of their assets to cover potential future long-term care costs. So it doesn't necessarily mean purchasing insurance, but it means taking a look at your overarching financial plan and making sure that you've planned for those potential costs in the future. For some people who are doing their plans in their late 50s or early 60s, looking at how they're going to cover the potential of a disability prior to full retirement is something that needs to be planned for. Less important, I believe, in most cases than someone who's in their 30s or 40s or early 50s. However, that may be an area in the plan that needs to be covered under this strategies to reduce risk. Property and casualty insurance should be something that's reviewed annually. If you take a look at your property casualty insurance, your homeowner's insurance, for example, every year, you may notice that the binder that they give you is thicker and thicker each year. And that's not generally more benefits that you're getting, but it's more exclusions that are taking things out of the way that you're covered in the policy. So having a competent advisor take a look at your property casualty insurance and making sure that it still meets your needs and it still has the coverages that you expect it to cover is extremely important. So for example, there are things that are covered in the past in property and casualty policies that are either limited coverage today or no coverage. That could be things like mold and spores. It could be things like a leak behind your wall that has now caused damage, but the leak has been going on unbeknownst to you for months, and the property casualty company now considers that a long-term automobile and vehicle insurance, boat insurance, things like that should also be reviewed annually and possibly quoted annually to make sure that you're getting the most competitive rates. Here in New Jersey, rates go up significantly every year, and there's a big difference between companies with regard to both coverages as well as premiums. So another area that's extremely important to think about is excess coverage. So generally, a auto policy may cover $100,000 of liability. A homeowner's policy may cover $50,000 or $100,000 of liability. There are policies called umbrella policies, which are basically excess liability coverage, and they will cover you for $1 million, $2 million, $3 million or more for literally a few hundred to several $100s a year in premiums. So that's something to talk to your financial advisor about and make sure that it's included potentially in your plan. Life insurance. So whether you've had life insurance your whole life and need that reviewed to make sure it fits in your overarching plan, or whether you need life insurance in retirement in order to cover things like estate taxes that might be due upon your death. Reviewing your life insurance is very important. My feeling on all of these insurances is that you want to utilize an advisor who doesn't have an incentive to sell you those insurances. So you want an independent review of your insurances by someone who isn't going to make potentially a commission or a kickback from offering that insurance to you. So who needs a comprehensive financial plan like this? Well, in my mind, everyone needs to at least think about these areas to some extent. So, of course, the more income that you have, the more assets that you have, the more complex situation that your life is, the more you might want to consider the professional advice of some type of trusted advisor. But even if you don't, I think it's extremely important to at least take these 5 critical areas and start to review your situation to make sure that you have all those things in order. And if you do feel like you need some help and would like to discuss your personal financial situation with us, I've left a link to our inquiry form in the description below, and please feel free to contact us. So if you liked this episode, please like, share, subscribe, leave your comments and questions in the sections below, and I will do my best to respond. I am Stephen Boorstein, and this is the Personal Financial CEO Podcast. I hope that you get in the best financial shape of your life and stay that way forever. Thank you.